Welcome to a deep dive into some fascinating source material you've shared with us. Today, we're unpacking a detailed report and some notes focusing on Gevorkyan, AS, specifically their performance in the first quarter of 2025.
That's right. Yeah. For context, Gevorkyan is a European company
Hmm.
known for being a leader in producing metal components. They use some pretty advanced techniques like powder metallurgy, sintering,
Right.
and also metal injection molding, MIM they call it. So think specialists in complex, high-precision metal parts.
Got it. And our source stack today, it's anchored by a Gafrik Research report from, June 5, 2025. It looks at their Q1 results, market position, financial health, the whole picture, really.
Exactly. And our mission, for this deep dive is to go beyond just listing the numbers. We want to figure out what these insights really mean for understanding the company right now. What are the key things you should take away?
Okay, so we're going to look at some, frankly, seriously strong growth in revenue and profit. We'll uncover this remarkable operational efficiency, especially when you stack it up against much larger global players.
We'll see how their diversification across different industries and geographies working out. And importantly, we'll zero in on the key risks and opportunities the sources are flagging. Okay, let's unpack this. Starting with those headline numbers for Q1 2025. What did they look like?
Well, the top line for Q1 2025 was definitely strong. Revenue came in at EUR 20.88 million. That's a solid increase, up 11.2% compared to the same quarter last year.
Okay, good growth there. But how did that translate, down to the bottom line, profitability?
Profitability was arguably even more impressive. EBITDA, that key measure of operating profit, hit EUR 8.35 million. That's up 14.35% year over year.
Right.
And net profit after tax, EET, saw an even bigger jump. It reached EUR 2.98 million, which is a 26.3% increase from Q1 2024.
Wow, over 26% jump in net profit.
Yeah.
That's substantial. In the report, it highlights something pretty striking about their profitability margin, doesn't it? Absolutely, yeah. Their EBITDA margin in Q1 2025 was 39.99%, basically 40%. The sources are very clear on this. They describe it as industry leading. In this kind of manufacturing, that is an exceptionally high margin.
Okay, so here's where it gets, really interesting, and maybe one of the most surprising things in the report. That incredible margin,
Yeah.
it isn't just a fluke, right?
No.
It seems driven by something fundamental, their operational efficiency.
Mhm.
The sources put this into perspective, comparing Gevorkyan to much bigger companies. How do they actually measure up on efficiency?
Yeah, this comparison is pretty remarkable. The report uses a key metric, revenue generated per employee. For Gevorkyan, this figure in Q1 2025 was EUR 125,301.
Okay, EUR 125,000 per employee. Sounds impressive on its own, but what happens when you compare that to those bigger peers? You mentioned Sandvik, Kennametal.
Yeah.
They operate in similar areas, right?
The difference is really stark. The report shows Sandvik at 71,452 per employee and Kennametal even lower at 50,976. So Gevorkyan, and remember, this is a company with only 166 employees, according to this report, is generating nearly double the revenue per employee compared to these global giants.
Double the revenue per employee. For a company their size, that's quite something. And that industry-leading 39.99% EBITDA margin we just talked about.
Yeah, the analysis says it's the highest in their peer group. So this combination, making far more revenue per person and keeping a much larger slice of it as operating profit, it really positions them among the most efficient players out there, regardless of size.
So based on the report, what's the secret sauce? I mean, what explains this standout efficiency? What are they doing differently?
Well, the sources point to a few things. A highly effective operational model, for one. Deep technological expertise, especially in those core powder metallurgy techniques we mentioned.
Correct.
Optimized production processes, and smart use of automation and lean principles. Essentially, they seem to have found a way to be incredibly productive with the resources they have.
Okay. And beyond just being efficient, the sources also highlight Gevorkyan's approach to diversification. It looks like they're deliberately avoiding being too reliant on just one market.
That's a critical strategic point the report definitely highlights. Their revenue is spread out. The biggest chunk, 28%, comes from automotive and agricultural machinery.
Okay, so significant but not, totally dominant. Where else are they getting revenue?
Well, healthcare, fashion, and electrical engineering. Those combine for about 17%. Defense is a solid 15%, and oil and gas contributes 12%.
Hmm.
And the rest is spread across smaller but growing areas like aviation and drones, compressors, things like that.
That broad industry base. It makes sense for stability, doesn't it?
Yeah.
And this diversification, it extends geographically too.
Yes, definitely. Europe is their core market, about 58%, but
Mhm.
North America is also a major contributor at 23%, and they also serve Latin America and Asia.
And even within their own processes, their own technology, they aren't just a one-trick pony.
Exactly. So while sintering, that's heating powdered metals into solid shapes, makes up 51% of revenue, they also have significant chunks from special materials for the oil industry, that's 19%, metal injection molding, or
But
MIM,
that's the one like plastic injection molding, but with metal.
kind of, yeah, that's 15%. Then soft magnets at 9%, and even 3D printing contributing 6%.
So if you're looking at this company, why does this extensive diversification across industries, regions, even technologies, why does it matter so much?
The report really stresses this. It's a fundamental de-risking strategy. It reduces their exposure if any single sector or geographical market takes a downturn. Ultimately, that enhances the stability and, the predictability of their revenues.
Makes sense. Now, the company isn't just sitting still, obviously. The sources mentioned some specific strategic moves, investments they made or continued working on. What stood out there?
They're definitely investing in that efficiency we talked about. In Q1 2025, they actually completed a project to robotize 2 calibration presses. The report says this was aimed squarely at optimizing production and reducing personnel costs.
Oh, okay.
They also expanded their physical production space, added over 1,000 square meters.
And how were these investments funded, according to the report?
They've used green bonds for financing. The second tranche, about EUR 7.5 million, was issued back in October 2024. It is worth noting, though, as the report does, that these particular bonds mature in 2026. That becomes relevant when we discuss risks later on.
Right. Okay, good point. Any recent commercial wins mentioned that sort of showcase their strategic direction?
Yes, the report points to several key ones. They secured 9 new long-term defense contracts covering both EU and US markets, so continuing that push into defense.
Mhm.
They also kept working on that big 30 million defense project awarded in 2024. Plus, they've expanded their involvement in autonomous vehicle projects, particularly in the US market. So these wins seem to align nicely with those strategic focus areas.
That mix of investing in efficiency and then securing key contracts in growth areas like defense and autonomous vehicles, it paints quite a picture. Let's look at the broader financial health now and how much visibility they actually have into future revenue. How does the balance sheet look?
Well, comparing Q1 2025 to Q1 2024, the balance sheet shows definite growth. Total assets increased by 15.81%, and total equity grew even faster, up 25.62%. So that indicates a strengthening financial base.
And for a company like this, that contract backlog,
hmm
that's a crucial indicator of future business, isn't it? How does that stack up?
Yeah, this is another area the report flags as a significant strength. As of March 31st, 2025, they had already contracted, get this, 93% of their projected revenues for the entire year 2025.
93% of the current year already locked in. That gives incredible visibility. What about further out, the years beyond?
It gets, frankly, even more impressive. They had 89% of projected revenues contracted for 2026 and 87% for 2027. I mean, that level of forward contract coverage, it confirms a very high degree of predictability. It really speaks volumes about customer confidence and the long-term nature of their business relationships.
That's really high visibility.
Yeah.
But what about debt? The report mentions a significant net debt figure. How does that fit in?
Yes, net debt is around EUR 78.93 million. Now, if you look at the net debt to EBITDA ratio, based on annualizing that Q1 EBITDA, it comes out around 2.36x.
Okay.
The reports are quite careful to describe this level of leverage as prudent and consistent with sector norms. They suggest it's manageable, especially given their strong profitability and cash flow generation.
When they mention return on invested capital, ROIC, around 7.5%, what does that tell us?
ROIC is a good measure, yeah. It shows how efficiently a company uses the capital invested in it, debt and equity, to generate profits. A 7.5% ROIC suggests they are effectively deploying capital and creating value. It's another positive sign of financial health.
Okay, let's shift gears slightly. How does the market currently view the company based on this report's analysis? What's the context around the share price?
Right, so as of the report date, June 5th, 2025, the share price was CZK 224. The Gafrik Research report includes analyst target ranges. They place it between CZK 310 and 330,
Mm-hmm.
and they estimate a fair value range of CZK 269 to 383, using standard valuation methods, price earnings, EBITDA multiples.
Okay, so the current price is sitting below both the original IPO price and these analyst estimates of fair value.
Mm-hmm.
But looking at the current multiples, like a PE of nearly 40 or an EBITDA around 27.5x,
Yeah.
they seem quite high just looking at them. How did the report square that?
Yeah, that's a key clarification point the report makes. While that EV/EBITDA multiple looks high at first glance, the sources explain it's significantly influenced by two factors specific to Gevorkyan. One is their capital structure, meaning their level of debt.
Okay.
And importantly, the other is their low stock liquidity, or low free float. Not many shares readily available for trading.
So it's not necessarily signaling that the market thinks the company is intrinsically worth that much based purely on its earnings or operations. It's
Yeah.
more technical.
Exactly. The report argues that this high EV/EBITDA multiple likely does not represent a true premium valuation based on fundamentals alone. It probably reflects these specific market mechanics, the debt level, and how thinly traded the stock is. It's more of a technical artifact, maybe, than a pure assessment of intrinsic value.
Interesting. And what about the PE ratio, that 39.45 figure? That also seems high.
Well, the report notes that while it also appears elevated, the PE is partially justified by some of the things we've already discussed. The company's exceptionally strong EBITDA margin, that robust multi-year contract coverage,
Right, the visibility.
and the resulting stable cash flows. These factors suggest a higher quality and predictability of earnings, which, can sometimes warrant a higher multiple.
Okay, so what does this all mean in the analyst's view presented in the report? What's the takeaway for you, the listener, regarding the valuation picture?
Well, the core message from this section seems to be that, in the report's opinion, the current market price of the stock might not be fully capturing the company's strong underlying fundamentals. That industry-leading efficiency, the high margins, the multi-year revenue visibility, the strategic positioning.
Right.
According to this analysis, there could be potential for future revaluation upwards, perhaps as the market comes to better appreciate these strengths, or maybe if those liquidity factors shift somehow.
Okay. The report also helpfully summarizes the company's situation using a kind of SWOT analysis: strengths, weaknesses, opportunities, threats, and key risks. Let's quickly hit the high points there. What are the main strengths identified?
Sure. Based on the sources, the core strengths are pretty clear. That industry-leading EBITDA margin we keep coming back to, the exceptional multi-year contract coverage giving that significant revenue visibility,
Oh.
their high production efficiency driven by technology and automation, and the well-diversified customer base across different industries and regions. Those seem to be the big ones.
And the areas identified as weaknesses or maybe potential challenges coming from within the company itself.
The main weaknesses flagged are that low free float and limited stock liquidity, which, as we just saw, impacts how you interpret their valuation multiples.
Mhm.
Also, the elevated level of leverage or debt, although, again, the report did qualify it as prudent and manageable compared to the sector. Exposure to the, cyclical nature of some sectors like automotive and oil and gas is also noted as something to be aware of.
Okay. And where does the report see opportunities for future growth? Where could they go next?
They point to increasing global demand for advanced powder metallurgy techniques like MIM and sintering as a general tailwind for their kind of business. There's also potential mentioned for expanding geographically, perhaps beyond their core European market.
Right.
And the long-term growth trajectories in defense spending and autonomous mobility technologies, those present pretty clear avenues for future business.
And finally, the external threats, the risks they flagged coming from outside.
Key threats include volatility in raw material and energy prices. That's a common risk for manufacturing, obviously, and could impact those nice margins.
Right. Yeah.
Rising interest rates and potential refinancing costs are also listed, especially with debt needing to be managed. And then just broader macroeconomic slowdowns or geopolitical disruptions are seen as general industry risks they face.
And it's probably worth just reiterating that specific point about the refinancing risk, right?
Yeah.
The green bonds maturing in 2026.
Absolutely. The sources explicitly highlight this as something to monitor, particularly in a changing interest rate environment. Getting that refinancing done smoothly will be important. And yeah, how raw material price swings could directly squeeze those impressive margins. That's a critical external factor to watch in this industrial sector.
Okay. Before we wrap up this deep dive, the report also mentions some notable recognition Gevorkyan has received recently, which kind of adds to their profile.
Yeah, a couple of nice mentions. The founder and CEO, Artur Gevorkyan, was recognized as EY Entrepreneur of the Year 2024 in Slovakia.
Oh, okay.
And the company itself was also ranked among Deloitte's 12 best managed companies in Slovakia for the second year running.
And there was even a high-profile government visit, wasn't there?
Correct. The president of the Slovak Republic visited the company back in March 2025, which, as the report notes, sort of underscores Gevorkyan's strategic importance within the Slovak industrial landscape.
Okay. So, pulling all this together from the Gafrik Research report and the notes, our deep dive really shows that Gevorkyan had a very strong Q1 2025. They delivered significant growth, high profitability.
Mm-hmm.
They demonstrate this really exceptional operational efficiency and are well diversified across markets and technologies. They've also got remarkable revenue visibility stretching out several years thanks to that contract backlog. And they seem to be strategically investing in automation in key growth areas like defense and autonomous vehicles.
Yeah, that sums it up well. And based on the analyst perspective presented in the sources, despite some of those seemingly high current valuation multiples, the report argues that factors like the debt structure and the low liquidity are really influencing those numbers,
Right.
and that the current market price may not yet fully reflect the company's strong underlying operational performance and future predictability. So it suggests potential for future revaluation, according to this analysis.
So here's a final thought for you to consider. Given the company's impressive operational strengths, that high contract coverage extending years out, and its strategic positioning in growing sectors, how might the specific risks identified particularly that need to refinance debt in 2026 and the ongoing implications of the stock's low liquidity, how might those ultimately factor into their long-term trajectory? What stands out most to you from this deep dive into the source material?